Well, good afternoon. Thank you so much for your attendance. We've got like a packed room here to speak about this. So the topic we're going to talk about today is OTC spot futures market, some of the trading practices, and hopefully we'll keep it interesting and relevant as well. So I'm joined here by a number of panelists. I'll introduce them. So we have Chung from Crypto Facilities. Sui is the head of cryptocurrency pricing products for Crypto Facilities, with responsibility for the firm's index suite, including the CME reference rate. Previously, Sui was a managing director of Euromoney Indices, the financial index business of Euromoney Institutional Investor PLC. We also have Steve Kelso from Galaxy Digital. Steve is a managing director and head of Europe at Galaxy Digital. Steve was CEO of First Round's multi-asset and equities business, Ashburton International. Before that, he ran trading at Renaissance Capital in Moscow, where he was head of the tactical trading groups. He also ran the Global Volatility Fund at KBC Alternative Investment Managers. And we have Alexi here on my right. Alexi Esmail-Yakas from Elwood Asset Management. Alexi is the head of product at Elwood Asset Management. At Elwood, he has built their proprietary trading business focusing on strategic risk exposure to crypto assets and their derivative instruments. Alexi started his career at Brevan Howard Asset Management, where he worked as a trader for the co-founders team. And lastly, we have Christopher at the end, who is one of the co-founders of Crescent Crypto Asset Management. Their vision is to bring the digital asset class to mainstream investors through secure, low-cost vehicles. Prior to Crescent, Chris was a VC at Goldman Sachs, where he managed assets for the Goldman Sachs Philanthropy Fund and Trust Company. Okay. All right. Great. Okay, great. You can hear me now. So I just wanted to start off, perhaps get a little bit of feel of the lie of the land a little bit. I suppose for my money, I think perhaps the kind of institutional trading, the trading facilities, and what we're looking at here is one of the things which actually developed a pretty breakneck speed. I suppose a function of that is the huge margins what some of these exchanges have gone through. A lot of VC money has flown in, a lot of interest from institutional investors and so forth. So perhaps, Steve, if you could kind of kick us off on you being on that side of provision of some of these instruments and so forth. Could you just give me an idea of where you think we sit in that kind of evolution of the crypto space and the ability to trade?
Sure. Okay. Thank you. So Galaxy is we're a merchant bank exclusively focused on digital assets. We have about a $500 million balance sheet. We're about $500 million market cap. And we have multiple touch points to achieve our sole objective, which is to be the institution's partner for choice entering the digital asset ecosystem. We have got 4 business pillars. We have an advisory business that lends money to any blockchain company seeking to make a raise. We have a principal investments business, which is, covers the VC and the private equity, which has been where much of the secret sauce to date has been in Mike Novogratz's sort of digital wealth creation journey, which has been colourful. The other 2 businesses then are really what we focus on more over here in Europe to date, the asset management business. And we've got a number of products there, again, solely focused on institutional asset managers and wealth managers. But our trading business is probably by a margin, the most active of the businesses that we have over here in Europe. So as I say, for us, we only face institutional clients. Anyone who follows our founder, you'll have seen the hashtag, the institutional herd is coming. And that is certainly what we built our whole company around, and we invested very heavily in building an institutional grade business across each of those 4 business areas. For us, the last year, like most participants in the ecosystem, it was a very challenging year, but there were really 3 significant institutional developments that happened sort of Q2, Q3 last year. First of all, we saw the investment banks actually getting off the fence, and the private wealth divisions in many of the big investment banks said, actually, we are now going to offer access to digital assets for clients who ask. And that was a pretty big, significant breakthrough after sort of months and years of speculation. Where are they going to touch this space at all? A much bigger development for us, though, was Fidelity's announcement that they were going to set up a trading desk, but more so custody digital assets, because this then spoke to the sustainability of crypto as an asset class that could be invested in. So we were very excited about that, and we had a big sort of joint announcement. But by far, for me, the most significant thing last year was that the tip of the multi-asset investment community, the US endowment funds led by David Swenson's Yale endowment, MIT, Harvard, Stanford, Chicago, a lot of these big US endowment funds announced that they were already in. And that was very significant for most of us, because we understood the process by which these institutions have to go through, the months and months of research, the investment governance committees, long before the investment committees themselves will sit down. So it was very telling that they had announced they were already in. And that was, very exciting for us, sort of, as I said, Q3 last year, until then obviously the price had a 45% correction. But what we are now seeing in the last few months is actually the ripple effect. And that is now permeating across more and more and more of the institutional asset managers and wealth managers. And that's borne out by the recent Fidelity survey, I think.
Sweet, perhaps you could pick up from that, as you're somewhat of a pioneer in this space of regulatory derivatives provision for institutions. How has crypto facilities, whereabouts do you sit, do you think, in kind of evolution of what we're going to see?
Sure. Obviously crypto facilities, aka Kraken Futures, is a cryptocurrency futures exchange, and we have our offering is regulated by the FCA as a range of investments, and so what we offer is effectively institutional grade, and although our platform both has retail and institutional participants, and I think that as Steve mentioned, that ripple effect, I don't think we've seen that ripple effect make such a large impact here in the UK, at least, or in Europe. I think that institutional first wave has really been confined to the US. I mean, correct me if I'm wrong, Steve. So I think that there's still quite a long way to go, particularly here in Europe, possibly less so the US, because also we don't have as many institutional investors. So our pension funds and our insurance companies, where capital forms and is sat, long-term savings pots, those long-term savings pots are sat, it's just a much more homogenous group rather than in the US, where you have all the way from pension funds, you have endowments, you have trusts, etc., etc. You just much wider range, and therefore, if you like, slightly more pioneering behaviour is more possible. Whereas here in Europe, the institutional fund asset pools are just larger and probably more conservative.
Great, thank you for that. Christopher and Alexi, if I can just turn to you, perhaps on the other side of the coin then, in terms of these exchanges and providers of the ways of investment products are evolving. What are the main changes you've guys seen? I mean, it's one thing to think about a trade. It's another way to the ability to put that kind of trade on and express yourself in a very kind of risk framework. Christopher, perhaps if you could kind of start a little bit about how is that? Are you able to do more things that you couldn't do in the past, or there's just noise that you don't ignore anyway?
Yeah, no, I think a lot of it is noise. I think what we've seen, and although it's anecdotal a bit, is just the difference in the run from when we started Crescent back in 2017 versus now. Just so much retail interest in 2017. Everyone says their cab driver was talking to them about Bitcoin. It's true. But then in this latest run, it definitely has been a much more, I think, institutionally driven run-up. When you look at blockchain analytics, the holders that have between 1 and 10,000 Bitcoin, the percentage of them relative to all holders of Bitcoin has gone up drastically, which just tells you that this latest run, all of the newest Bitcoins that have been minted, the last million Bitcoins that have been minted, half of them have gone into that bucket of wallets that have between 1 and 10,000 Bitcoins. It just gives you a sense that a lot of the accumulation that's happening in the space is really at the larger, more institutional level. And that follows, I guess, my anecdotal experience just managing our fund. We've seen a lot more interest from institutional asset managers, whether it's family offices or RIAs, or even talking with endowments and pensions who before we wouldn't even get a conversation with them necessarily.
So do you think they're not, the kind of institutional investors aren't actually looking for these kind of new portfolio tools? They're just buying Bitcoin and sitting on it?
Well, it's funny. There's a lot of new fund managers that are out there, even new funds that are that have been launched that are really high profile. I think you mentioned Yale. I think was that Paradigm, or yeah. So like fund managers like Paradigm who are looking at the entirety of the cryptocurrency space, probably more focused on venture capital and getting in on some of these equity deals with some of the infrastructure in the space. But even that fund and others are buying large amounts of Bitcoin. Anyway, they all are going to have some sort of allocation to these coins, so I think that definitely contributes to what we've seen in this move.
Alexi, perhaps I could bring you in, because you have quite a broad mandate of what you're able to do in terms of putting your risk exposure. You can take some pretty...
Yeah, so I mean, the template that we have, the template that we have from at Elwood is essentially copying our heritage from Brevan Howard. I mean, we're two very separate entities, but our founder Alan Howard is the founder of Brevan Howard as well. So we're taking that knowledge that we learned at Brevan Howard from the hedge fund space and porting it over to cryptocurrency. Now we see a lot of opportunity in the markets, whether it's arbitrage and looking at the different trading opportunities, and that's very different to what people like Paradigm and Yale are doing. So they're going for the beta plays, so they're looking at long only plays. We're looking at alpha generation, what we can do there. And so we're more interested in different products that come into market, so futures, swap products that enable us to have a more balance sheet efficient way of gaining exposure to the market and increase our returns that way. Yeah.
Thank you. Can I just turn to a theme about kind of derivatives and futures markets, and that's kind of regulation. So the FCA a little while ago came out and they highlighted the dangers of derivatives used for retail investors. And crypto is a largely retail market. I just wondered your kind of views philosophically and practically about these things. Are derivatives use a good thing for the market? They create stability, ability to hedge, capital efficiency, or these are ways for really capital, for retail investors to get stung a little bit and for exchanges to make money? What is the reality that you guys think?
I think it's bad for stability. I don't think retail should really be getting involved with margin too much. Especially, it's completely insane that you have volatility. Implied volatility at the moment is 90%, and you have 100 times leverage that you're able to get. It's nuts. We had in traditional markets when the Swiss peg broke a couple of years back. People and retail investors get significantly burned on much lower levels of leverage, and you've got an asset class which is much more volatile than the Swiss currency, and you're enabling retail to do 100x leverage. But it's an incredibly profitable thing for BitMEX, and they're doing very.
So the FCA, in your mind, would you say the FCA should ban crypto derivatives for retail use?
I think they should. You should stick to institutional investors to keep to that stuff. They have experience, and whereas I think spot markets and holding Bitcoin on its own is volatile enough for people to get good returns if that's what they want.
Great. Steve, do you agree with that?
Yeah, I would be very surprised if the FCA don't come out very soon in the next couple of months and take action against that. I think as someone who has traded derivatives for the best part of the last 25 years, we've seen this movie before with the adoption of derivatives across mainstream multi-assets, and I think a big issue is that stigma of the man in the street losing out.
Yep.
As Alexi says, the retail, some of the retail products that have been out there, particularly binary options, have correctly drawn a lot of criticism. And I think as soon as the regulator is seen to protect the man in the street from technology that is not appropriate,
Sure.
that does the whole institutional realm of service as well.
Okay. Sweet.
So obviously, as a FCA regulated provider, we abide by the ESMA guidance. So on our platform, retail investors are limited to 2x leverage. We think that there's obviously a difference between the capabilities and resources of a retail investor relative to an institution and a professional. Now, there's a significant difference in their resources, but fundamentally I think that you do have some retail investors with a lot of experience, a lot of knowledge of the space, and significant experience in trading. So, our approach is the sort of classic approach of appropriateness. So every user that comes to Crypto Facilities undertakes an appropriateness survey, so that we classify them correctly, and for retail investors that means 2x leverage. So I think that what we've seen through that, we, again, being FCA regulated, investors have access to the financial ombudsman. We have not had any complaints. So that's how we manage that whole piece of appropriateness and whether our products are in the right hands. Obviously, for unregulated, undocumented venues, that doesn't exist. So, BitMEX has been mentioned, Deribit, etc. So, I can't speak for how users of that platform, whether the products are suitable for them. But as the guys have said, and I echo that, derivatives are by their nature complex. It's a very volatile asset class, and whether it's appropriate for retail investors is questionable at those sorts of 100x leverage.
Yeah, I think I generally agree with the latter piece that Suya mentioned. I think heavy-handed regulation is something that's not great, and I think to just blanketly say that retail investors can't participate in that market is not ideal. You don't want people that either you need to be ultra high net worth or an institution in order to participate in certain financial products. I think something like an appropriateness level, whether it's if you're a retail investor, you only have access to certain levels of margin, or you have to prove that level of sophistication by taking some sort of survey. I think that's a much better option if there were going to be restrictions versus just blanket removal. I think risk disclosure, like requiring BitMEX to disclose the risks and limit certain clients is a much better option than BitMEX basically having to shut down.
Far more pragmatic approach, judge on a risk basis, I think, rather than just blanket.
I also think that London is the derivatives capital of the world, and it needs to be seen. The regulators need to be seen to be proactive and take the lead here. Last week there was a very big expo, the IDX. All the big derivative exchanges met in London, and there was a panel with the CEOs and presidents of 5 big exchanges: Eurex, the biggest derivatives exchange, Deutsche Börse here in Europe, LME, CME, Osaka, the big Japanese exchange, all recognizing that this is the derivatives capital of the world. They were all giving out the message, we're prepared for a hard Brexit, this is where the business is going to be, and very aware that the Chinese exchanges were now coming to London as well. So I think, London needs to hang on to that. It's doing the right things, but we need that regulation.
Okay, we have about 10 minutes left, so I've got one more quick question, and I want to leave about 5 or 6 minutes to keep your answers relatively brief now. Just about looking forward now, so kind of innovation. I think, Alexi, when you go out there and look at, what's the thing that you think you need, or you want, or could be better, or what's the kind of future? What do you think the next kind of next step we take on this journey is?
Yeah, I mean, in traditional markets, one of the big drivers of increasing volumes was having things like clearing. I think that's a big thing right now that I would like to see, and prime brokerage.
Why would clearing be important?
Because it means that I can trade on one venue here, Crypto Facilities, for example, and trade on BitMEX, and my risk on both can be netted off at a clearinghouse.
So a clearinghouse for you. Steve?
I think the institutional tools of choice are coming for hedge funds. We've got the lending and the borrow now, we've got the options, we've got the derivatives. For me, though, a very significant thing will be physically settled futures. I think when we've got physically settled futures, then we'll see all those big multi-asset exchanges all come in and adopt them. I think the volumes will explode.
What is it particularly about physically settled which is important, though?
I think there is a lot more confidence with traditional derivative players. They are less susceptible to manipulation, is one sort of common debate. But I think just as soon as we see that, then that will be a big line in the sand.
Right. So physically settled derivatives. Sweet.
I think that more and more, the word institutional gets used a lot, and it can mean lots of things. I think what the one aspect that I'm most interested to see is more collective investment schemes, effectively, however they're structured, but more collective investment schemes that allow both institutions and individuals, or anyone with £10 to £1 billion to invest in a collective investment scheme that is exposed to cryptocurrency. I think that will make a very, very big difference to the market.
So, got a very basic building block,
very basic.
Something.
Yeah, nothing too grand.
Just a way to.
It doesn't have to be an ETF, right? It could be a mutual fund, could be, but one that's open to all investors, because all the collective investment schemes that currently exist have marketing restrictions of some degree. So one that is indeed open to all would be a very welcome development.
Christopher?
Yeah. I was going to say an ETF as well. I mean, when we started Crescent, our goal was really to create easily investable, complexity-free vehicles. Unfortunately, our index fund that we launched, we couldn't do through something like an ETF back in 2017. It's been tried and unfortunately hasn't passed. But an ETF provides distribution to everyone, right? Today, there's so many hurdles to investing into cryptocurrencies, and that's what we set out at Crescent to do. Our fund today is a private implementation of an ETF, essentially. We try and make it very liquid, low cost, etc. But we've recently filed for an ETF partnering with USCF in the United States. And the goal is really to bring a basket of cryptocurrencies, the largest, most liquid cryptocurrencies, easily accessible to everyone. And I think that would, I'm sure some of you listen to Tom Lee, it would probably make the prices of cryptocurrencies go ballistic, just because of the token economics. But I think that's the ultimate goal, to get broader exposure into the space.
So we have around 5 minutes left. So I'd like to open it to questions. Is it this mic that they're going to be? Gentlemen here at the front.
Hi, that was interesting. Thank you. I've come to this world just from trading crypto to start with. So I'm no stranger to playing with high leverage. But I kind of wondered how this works in the more traditional markets. A feature of trading on BitMEX is there are people that game the index. Like a few weeks ago, someone did a massive market sell on either Kraken or Bitstamp and managed to crash the price by $1,000 just from over-leveraged traders. So maybe reducing the leverage people can use would help with that. But is there anything else that can be done, and how is that covered in the old-fashioned markets? Given that the institutions have got so much money to play with compared to what crypto's used to seeing, that I'm sure that could just happen even more with people with bigger stacks.
Yeah, I think I can start there. I think one thing that's interesting is really strength around indexing and to prevent market manipulation. To your point, people look at what the methodology is underpinning those, whether it's some sort of margin trade or derivatives trade, and they try and game that system, right? So something that Sui and I were recently just talking about is how do you use data to make an index or an underpinning methodology as strong as possible. If the underlying piece is simply we're using Kraken spot prices, someone could easily try to manipulate that, right? If you're using data sources from multiple exchanges with multiple parameters in place that adjust for one person dropping $1 million of Bitcoin on a spot exchange in a market order, the underlying index needs to solve for that, essentially, to make it stronger so it doesn't just wipe out a bunch of people's margin positions.